Welcome, everyone, and thanks so much for joining us for today's webinar. My name is Mary Ann Hensley, and I'm the Vice President of Marketing here at FreightWaves. And we are excited to be here and happy to present this monthly market update webinar in partnership with Convoy, which is dedicated to utilizing technology to bring reliability, transparency, insights, and efficiency to the trucking and supply chain industry. Today's market update is going to touch on some of the latest developments affecting freight as we wrap up 2018. We'll be hearing from FreightWaves Chief Analytics Officer Dean Croke, as well as our Chief Economist Ibrahiim Bayaan. Before we get started, I'd like to cover just a couple of quick items. First, if you have any issues during the webinar, please feel free to reach out to our team via the chat function on your Zoom control panel. Also, if you have questions that you would like to ask our presenters, please enter those through the Q&A box in your control panel, and we'll answer as many of those as we have time for during the live Q&A after the presentation. We'll also be sending a link to the recording of this webinar if you would like to view it on demand or if you'd like to share it with your peers. And at this point, I'd like to go ahead and turn it over to Dean and Ibrahiim to share their insights on the latest factors affecting the freight market today. Ibrahiim, take it away.
I think just initially what I'd like to do is maybe just set the scene, Ibrahiim, because this has been a year of sort of unprecedented activity here at FreightWaves. And for those that are kind of new to the FreightWaves community, we're building a world-class community of freight that uses data and technology to understand, analyze, react, and forecast and de-risk the market. So one of the things, for those of you that are subscribing to our editorial side of our business, you'll notice that we have a lot of high-quality folks on our editorial team, includes a couple of economists, including Ibrahiim, who you'll hear from today. We also have 2.7 times more traffic than any other freight-related website. So if you're not already subscribing to our FreightWaves.com editorial side of our business, now would be a really good time to jump on that so you can stay in touch. One of the things you'll find about FreightWaves is that we combine a lot of really interesting data points with tribal knowledge. That's what makes our business interesting. On our market expert team that Ibrahiim and I are part of, where we send out regular daily updates to our Sonar community via the Daily Watch, you'll see that we have a number of people that have very distinct levels of expertise in key areas. And it's the combination of data and this tribal knowledge that we've been able to pull together that's made our business such an interesting one. And hopefully some really good insights will come out of that today. But Ibrahiim, before we jump into the economic side of the business, if you remember back to March when we were hearing about record levels of Class 8 trucks, and I wrote to you and said, do you think there's enough demand to sustain this? And because I couldn't see it, this has been a year of unprecedented activity. You know, we've got trade wars, we've got geopolitical activity, we've got oil prices now down trading under $50 a barrel. We've had the ELD hard mandate come in April. We had sort of significant shipper constraints in certain markets. We had really high rates in flatbed. We had a war on detention with ELD mandate, and shippers were forced to either play nicely or suffer rate increases. And of course, tomorrow we've got, on the back of all of that, we've got some economic uncertainty and fear of rising interest rates. So it's been a wild year. It's been a real roller coaster ride for truckers who've seen, tight capacity, high rates, and it's kind of almost reversed now, where we're seeing this macroeconomic overlay sort of suppressing a lot of the activity that we saw mid-year. So with that, I'm going to hand it over to you and then dig deeper into the economy side of it, and then I'll come back and talk a little bit about some of the freight market activity that we're seeing specific to Sonar.
Thanks, Dean, and welcome to everybody that joined us on this webinar. I think you raised a pretty interesting point, that it's been a very interesting year, especially as it relates to freight demand. When you think about sort of the economy and the performance throughout the course of 2018, I like to look at it as just like an economy that was doing pretty well, and then we injected some additional stimulus into it, and you end up with an economy that's doing extremely well, especially as you get to the middle part of the year. So this chart here that I pulled up shows the quarter-over-quarter growth rates in GDP, and then also the year-over-year growth rates, which is the black line here. And you can see the second and third quarters of this year growing 4.2%, 3.5%. That's the strongest back-to-back quarters of GDP growth since 2014. So just to give you guys a feel of how quickly the U.S. economy was growing, at least at one point in time during the year. Craig and I started these webinars back in the middle of the year, sort of in the midst of all of this. And I remember at the time saying that, don't get used to it. At
Right.
some point, the economy is
Right.
going to start to slow back down,
Right.
and I think we're entering into that kind of phase of economic growth. You can see the fourth quarter projections that we have here. I have it at 2.4%. It should be somewhere around that range.
Right.
And I think as you go into 2019, it's going to be much more likely that you start to see these growth rates around 2.5, somewhere between 2 and 2.5% quarter after quarter after quarter, instead of seeing these big 4+% or 3+% kind of growth rates in the economy. Now, from a year-over-year perspective, it's still pretty good. I mean, if you look at the black line, you can see just a gradual acceleration in the economy throughout the course of the year. I think by the time you get to the fourth quarter of this year, we'll be looking at growth about 3.1% year-over-year. That's very strong. I mean, I consider trend growth in the economy to be somewhere between 2 and 2.25%. So to have a year where you're kind of ending up 3.1% higher than you were the previous year, I think it's very strong performance. So a couple of things to note about the fourth quarter and where I think the strength is coming from. Consumer spending has been a strength throughout most of the year. There was a bit of a hiccup like right at the beginning of 2018 where consumers took a bit of a breather from spending. But since then, the retail sector has been on a bit of a tear. And I think overall consumer spending is going to continue to drive economic growth as you enter the last couple months of 2018. The third quarter of this year had a fairly sizable drag from international trade. There was a surge in imports that occurred during the third quarter, which subtracted quite a bit from GDP growth. I don't think that's going to be there in the fourth quarter. And so as a result, you won't see the same big kind of drag in the fourth quarter results that you did in the third quarter. And then also government and business spending should be a reasonable source of demand in the fourth quarter. I don't think neither government spending or business spending is going to be as strong in the fourth quarter as it was, say, in the earlier parts of the year. But I do think that it's going to contribute in a positive way to growth at the end of the year. Some sources of weakness in the fourth quarter. I think there's less inventory building going on than there was, say, in the third quarter. I mentioned that there was a big drag from trade in the third quarter. A lot of that was imports that were just being stored in inventory. So you had a big drag from imports. It was offset by almost a 2 percentage point contribution just coming from inventory building during the third quarter. So I don't think that's necessarily going to be as large in the fourth quarter. I think there's still some inventory building going on, but you're not going to get the same kind of contribution to growth. The housing market's been a source of weakness throughout the course of 2018. I don't see any turnaround in that in the fourth quarter. There were some reasonably positive results coming from the housing sector this morning. But still quite a bit of weakness in housing and construction activity. And then the last thing is just starting to see signs that manufacturing output is beginning to slow down quite a bit. As in the middle part of the year, it felt like the manufacturing sector was growing almost too fast for its own good, that there was more demand for manufactured goods out there than the businesses even had the capability to produce. So you started to see backlogs of orders and businesses that couldn't keep up with the amount of orders that were out there. But I think some of that is starting to die down as well. So you're not going to see as much activity from the manufacturing sector in the fourth quarter as you did earlier in the year. So digging in a little bit into industrial output and the manufacturing trends, the orange line here is total industrial production. You can see industrial production growth isn't quite as high as it was in the middle part of the year. It had gotten above 5%, close to 5.5% year over year, and it's come down over the past couple of months. A lot of that is really just more difficult comparisons to last year. Like industrial production really started to take off towards the end of 2017. And so as you start to have these year over year comps get tougher, you expect some of this moderation in growth rate. I don't think, I never really expected year over year growth to stay in this 5% range anyway. A bit more concerning is what's going on with the white line, which is the manufacturing production, which strips out like the mining activity and the utilities production that goes on in total industrial production. There we've actually seen some loss in momentum. The November results came in for manufacturing. It was essentially flat, and there were some pretty big revisions to September and October data that just showed a weaker trend in manufacturing activity overall. So, whereas say at this time last week, I would have said manufacturing looks generally healthy. After they go back and revise the data and show some of the weakness from November, now it looks like manufacturing is sputtering along quite a bit.
Right.
I still think it's positive in general, but I just think it'll be a significantly less growth and activity in the fourth quarter than what we would have seen, say, in the second and early parts of the third quarter. So drilling in a little bit into the industrial production trends, just to give you guys a feel for what's driving overall manufacturing activity, I broke down the manufacturing industrial production numbers between sort of what's durable goods and non-durable goods. Durable goods are things that get produced that are expected to last over 3 years, and so that would be things like automobiles, appliances, furniture, things like that. Those are going to be your durable goods, and durable goods have fared pretty well. All things considered. Like, if you look at the growth rates, it's come down a bit from these early year highs, but again, all of that I think is really just more difficult comparisons rather than any kind of loss in momentum. When you look at the production of automobiles, it's still doing fairly well. It's above 3% year over year. Furniture and electronics equipment all doing very well, but there's quite a bit of weakness coming from the non-durable side of things. So non-durable goods are going to be food and beverage manufacturing that we do, chemical products, clothing, things of that nature, and quite a bit of weakness there. And in fact, as of November, like the year-over-year growth is barely positive. I mean, you're looking at less than 1% growth year over year there. The thing about durable goods going forward is that you have to begin to worry about like pent-up demand. Like a lot of the reason why durable goods are doing well is because consumers are still unleashing the last little bits of pent-up demand. But eventually that sort of thing wears out. I mean, you don't buy durable goods every year. That's the reason why they're durable goods. They're designed to last for a while. And so you do begin to wonder, like, once pent-up demand starts to run out, sort of what happens to the durable goods side of things. And so, again, overall, I think the manufacturing sector has a bit of weakness coming from the output numbers over the past couple of months. Now, it's a little bit surprising because when you look at some of the survey data coming out of the manufacturing sector, it still looks pretty positive. I have here the Institute of Supply Management, their Purchasing Manager Index from the manufacturing sector. For those that aren't familiar with the PMI data that comes out of the Institute of Supply Management, essentially it's just a survey of whether or not business activity is expanding or contracting among purchasing managers. Purchasing managers are going to be the people that sort of buy supplies for the factory and things of that nature. And the number that comes out of the Purchasing Manager Index is essentially the percentage of respondents that say activity is expanding. And so when you get numbers above 50, that means more than half of the survey respondents are saying activity is getting better. If it falls below 50, it's a sign that activity is contracting because more than half of the respondents are saying activity is contracting. Historically, when you get numbers that are above 55%, that means really good growth in the manufacturing side of the economy. And you can see these numbers have been well above 55 throughout the course of this year, and they're close to 60 as of the most recent readings in December. And so that means there's a bit of a disconnect here. You have the survey data saying manufacturing still looks pretty good, and then you have the output data that says, oh, manufacturing is slowing down quite a bit. You know, the good news is these kind of disconnects resolve themselves usually pretty quickly. That when you find them sort of sending these conflicting messages, one will catch up to the other, or the other one, or one will fall down to match the other one. But for now, it's a little bit difficult to disentangle which one is sort of telling the truth here.
How far out? I mean, the PMI is a monthly survey, but how far out do you think survey respondents are looking when they respond to this? Are they just looking on a 4-week cycle, or do you think they're looking longer?
So in this particular survey, they just ask you how activity has been doing over the past month.
Right.
Now there are components of the ISM data that are much more forward-looking. For example, there's a question on the survey that asks about like what your new orders look like. Normally, you can look at like what survey respondents are saying about their new orders to get an advanced look to what future production is going to look like. But for a lot of these indicators, they're really just asking like what's been going on over the past month.
Review looks, that's what takes a while to catch up. Got it.
And historically, the correlation between like year-over-year growth in manufacturing production and these PMI readings are very tight.
Right.
So it's, when you get these kind of disconnects, it does, again, like I said, they resolve themselves pretty quickly, but it does raise some eyebrows.
But it's generally considered a pretty good indicator of GDP, right? It's a leading indicator of GDP growth.
Well, yeah. So To the extent that manufacturing tells you something about GDP,
Right.
yes. Now there's a whole separate side of the ISM data which covers the service sector of the economy. And keep in mind that the service sector of the economy is the bigger portion of the U.S. economy. So if you look at both of those, you get a pretty good feel for what GDP is going to do. On the retail side, retail growth has also come down a bit from some of the earlier highs. If you look at here, the year-over-year growth rates in retail sales exceeded 6.5%. A couple months ago, it's come down since then. But like industrial production, a lot of that is really just more difficult comparisons to last year and not necessarily any significant loss of momentum. The numbers from November were pretty positive, even considering the fact that like gasoline prices plummeted in November, and that weighed down the overall retail numbers. The core stuff, excluding automotive sales and gasoline sales, looked very good. The holiday season looks to be proceeding just fine, and I think retail is going to continue to be one of these strong points in the economy as you go forward. And the reason I say that is because the fundamentals for consumer spending still look positive.
Still pretty confident.
Yeah, I mean, as long as job growth holds up and wage growth picks up, and you get this solid income growth, and consumers feel confident about spending, then there's no reason to expect that consumers are going to spend less than what they were before. I mean, you can always look at consumer spending as sort of like the combination of how willing you are to spend on things and how able are you to spend on things, right? And so the willingness talks about consumer confidence, right? As long as consumer confidence is high, that means consumers are willing to spend, and the ability to spend goes to these things like income growth and expansion of credit and things of that nature. All of those things are pointing in the right direction right now. Confidence is high, income growth is good, so I think retail is probably fine as you go forward. With the caveat being that you need these fundamentals to hold up in order for consumer spending to hold up.
What sort of catalyst might there be that would change that from a consumer confidence perspective? We had tax cuts this year. The job growth, unemployment numbers are at 50-year lows.
Sure.
What sort of things might change consumer confidence, do you think, going into the new year?
Well, there's a couple of things. One is if businesses start hiring less. I mean, it's always easy to feel confident as a consumer if you walk out and there's job openings everywhere, and you can always get a job. And so if businesses get scared by the outlook and they decide to not bring on as many workers and hiring slows down, then you may see consumer confidence slip some. I was a bit concerned that this recent plummet in stock market prices was going to cause consumer confidence to drop down. That hasn't happened yet. I mean, the consumer confidence has dipped a little bit, but considering how much the stock market has fallen, I think it's pretty remarkable that they're still as optimistic as they are. And then the other thing is, I think next year, the impact of tariffs are going to hit the consumer quite a bit harder than than they did this year. And so if you find significant rises in prices of things that consumers typically buy, that might lead to consumers feeling a lot less confident about the state of the economy as it starts to hit home some.
I noticed this week that the Bureau of Labour Statistics, I think it was, reported that the term ghosting becomes an official statistic now. And in the trucking industry, we've had drivers, ghosting for a long time, where they, might drop the keys in a diesel tank and say, "I'm leaving," or just abandon the truck at a truck stop. That's not an unusual thing, but it's interesting to see in the non-trucking community that people just abandoning their jobs and not even turning up. And this term ghosting has now become an official term.
That's right. And it's one of those anecdotal ways of just telling you how strong the job market is. I mean, you have to be pretty bold to just have a job that wants to hire you, and you just kind of walk away from it just because you feel like there might be something better for you out there.
Well, I was talking to a colleague of mine in Boston was telling me about his landscaping business, and they make double their income. Income doubles in winter, which was kind of counterintuitive. They actually make more money in winter than they do in summer, but a large percentage of that workforce comes from H-2B immigrants, a lot from South America. And they said, we can't survive without bringing in, high number of people on visas to just manage the workload of removing snow from the northern latitude. So it's a very strong employment market at the moment.
Sure. And like Dean mentioned, the unemployment rate's around a 50-year low. The last time it was this low was in 1969, so not quite 50 years, but pretty close. And very impressive by almost any measure. The idea of this being a particularly tight labor market is helping to fuel wage growth. I mean, you're finding more and more businesses having to increase their wages in order to attract some of these workers. I mean, all of this stuff, you kind of got an advanced look within the trucking industry before it kind of hit the economy overall. That, you know, these carriers, I mean, they're already used to having to bid up wages to try and attract drivers, and it's become sort of an economy-wide sort of phenomenon. When you look at wage growth, it's the strongest it's been in years since the recession, since the tail end of the recession years. And again, I think as long as these labor market conditions hold up, then that provides a pretty solid foundation for consumer spending. And it also provides a very solid foundation for the overall economy, because consumer spending is so much of economic activity. Looking on the trade side, there's been quite a bit of fluctuations in trade performance, really since the early part of the year, ever since the Trump administration began talking about tariffs and the possibility of tariffs and then implementing them. It's caused fluctuations both on the export and the import side. But I think generally speaking, trade performance has been fairly strong throughout the course of the year. Here you just have year-over-year growth in goods exports. It's come down from some of the earlier highs, like a lot of things. This feels like it's sort of a running theme of this webinar, that things have come down from mid-year highs. But you can see export growth was within the double digits solidly in the middle part of the year, and it's eased to about 8% year over year. Now, again, a lot of that is really just tariff-related fluctuations. The surge earlier this year was just a rush for U.S. companies to get some of their agricultural products out and into China before the tariffs were implemented. And then on the back end of that, you get a bit of payback. That if you export things earlier than usual, then when it's actually time that you would normally export, you don't have that same kind of performance, and so you get that moderation back. But again, I think overall export growth looks pretty good. These kind of tariff fluctuations are probably going to continue until we come to some kind of conclusion on where tariffs are going to end up. But there are also some pretty important fundamentals at play also in export performance. You know, the condition of the global economy has also been showing some weakness lately. Like when you look at Europe or you look at China, these are two significant export markets for U.S. goods, and both of them are showing signs of slowing down. At the same time, you get the dollar that's gaining some strength. It's risen almost 9% since the start of the year. And as you get a stronger dollar, that makes it more difficult for you to export to the rest of the world as well. And so there's some fundamentals that are at play with export performance, aside from all the tariff-related fluctuations, which I think are influencing sort of the month-to-month changes.
On the export growth side, you know, there's a lot of talk about the soybean market and how I think the exports of soybean almost dropped away to zero. But anecdotally, we're hearing that those growers have found other markets, particularly in South America. So, you know, that's part of the reason export growth will remain generally strong. Would you agree? Because people have been able to find alternate markets.
Sure, especially over the long term. Like these supply chains will kind of adjust to what the new tariff or trade policy reality is going to be, and they'll re-optimize and figure out what the best way is to get things from point A to point B. It also helps that China sort of backed away from their soybean import ban that they were implementing over the past couple of weeks. So it should be some pretty significant relief for agricultural farmers in the U.S. in upcoming months.
Got it.
And similar sorts of things on the import side. I think generally speaking, the import growth has been very strong. That goes along with having a U.S. economy that's growing at a fast pace. That if consumers are doing well and businesses are spending, they tend to import more, aside from the month-to-month fluctuations that might come from trying to adjust to tariff policy. And again, just like the strong dollar hurts exports, a strong dollar helps imports into the country. It's also helped offset, I think, some of the impact that tariffs might have otherwise had. I mean, you can consider that, like, for a lot of these goods that are being imported into the U.S., there was a 10% tariff that was imposed on quite a bit of them. At the same time, the dollar is about 9% stronger, and so that erases most of the kind of impact that you get from tariffs on the import side. Quite a few policy developments over the past couple months, I think, with some relatively significant implications for next year. There's fiscal policy changes, monetary and trade. I have here President Trump, Chairman Jerome Powell of the Federal Reserve, and then President Xi from China. And I think the decisions that these three individuals make over the next couple of months are going to go quite a ways in determining how the economy evolves next year. On the fiscal side, kind of an unanticipated risk has emerged over the past couple of weeks with the threat of a government shutdown. The government has a deadline of midnight on Friday to reach some kind of agreement on funding parts of government activity. Otherwise, those parts are going to shut down. I think it's important to note that maybe 2/3 of the government operations are already funded and that they're not going to be subject to any kind of shutdown. Right. So it's about 1/3 of departments and programs that the government provides that would lose funding if there were if they were to reach this point of shutting down the government. The effects on the economy, I mean, it really just depends on how long the shutdown lasts, if it comes to that. A lot of people don't know this, but the government has already shut down this year twice. They shut down earlier in February of this year because of sort of disputes over dreamers and people that were born in the U.S. Right. But it only lasted for I think maybe a couple of days before the government was up and running. And so from a macro perspective, it wasn't even worth noting. The last time there was like a significant government shutdown was back in 2013, where the government shut down for a couple of weeks in October. And that had a noticeable impact on GDP growth, about a couple of tenths of a percentage point. Okay. And so if you get one of these kind of shutdowns where we cross over into shutdown territory, but it doesn't last long, it probably doesn't mean a whole lot from an economic standpoint, other than the fact of whatever policy changes it takes to bring it to a conclusion. Right. But if it turns into a very long, prolonged government shutdown, then it's time to revisit exactly what that means for fourth quarter growth or growth going into next year. I would also say that it's coming not at an opportune time. I mean, it's not like everything else in the economy is pointing upward right now. So to have this government shutdown on top of a stock market that's already tanking, it's just not a great time for it. On the monetary side, the Federal Reserve began meeting today. Tomorrow they'll announce their decisions that they have on interest rate policy. I think most expect that there's going to be a fourth interest rate hike of the year when they announce tomorrow. I think there's quite a bit more doubt around that now than what there would have been, say, a month or two ago. Very rare that you find like the Federal Reserve that actually hike interest rates in the middle of like the stock market plunging all around it. So they may come back tomorrow and decide to keep interest rates constant. I think more importantly, they've made it fairly clear that they're willing to have sort of a pause in interest rate hikes going forward. That as you go into 2019, I think initially the thought was there'd be like another 3 to 4 interest rate hikes in 2019, just like there was in 2018. But the Fed chair and several other Fed members have come out and said, maybe we'll just have, just a couple, or we'll take a break somewhere in between there and not hike rates as fast. Right. Now, higher rates, they affect consumer spending, of course, particularly in the housing market. I mean, I think one of the reasons why there's so much weakness in housing right now is because interest rates have been rising for mortgages. They also affect business spending. The other important thing to note is that there's a pretty long lag between when the Fed decides to make these changes and when it actually takes hold in the economy. And so, as you look into 2019, the pace of monetary policy might slow some next year, but keep in mind that I think the economy is still going to be affected by what happened in 2018 as you go into 2019. Like, you're going to start to feel the effects in 2019 from the 4 rate hikes that we had in 2018. And so the pause it's nice from a longer term perspective, but I think in a lot of ways the damage has been done in terms of how monetary policy is going to affect the economy. Got it. And then the last thing is trade policy. There was a big meeting at the G20 summit at the end of last month, in which President Trump and President Xi of China, they sort of got together and agreed to a ceasefire in this trade escalation. And so there were quite a few tariffs that were at 10% that were scheduled to increase to 25%, but that was delayed until March of this year. Right. And China's even gone further. They've taken some of the the auto tariffs that they hiked up on U.S. exports of autos, and they've rescinded some of those to previous levels. So they were 40%, they were rescinded back down to 15%, and they also agreed to purchase some of U.S. agricultural products, those soybeans that we were talking about earlier. They agreed that they would stop banning imports of soybeans. And so some positive news in that regard. The downside to all of that is what it really means is that there's going to be even more uncertainty going on. Like in 2018, one of the big themes of it all is that there is this cloud of tariff uncertainty that weighed on everybody's mind. And I think that probably continues until you get to some kind of conclusion between the U.S. and China. Even if it's not necessarily an ideal solution, it would at least give some clarity to businesses so that they know how things are going to proceed. Right now, it feels like everybody's just operating, trying to hedge their bets as best as possible in case the worst happens. And until we get to that kind of resolution, I think it continues.
So on that, Ibrahiim, one of the things that we're hearing from some of our partners in Asia is there some serious concern about the outlook for 2019. And in the first week of December, we heard from Alpha Liner that there were 6 sailings cancelled between Asia and the United States. And the interesting thing here is that the trade between the two countries represents 38% of all global containerized freight. So the world kind of looks towards these origin-destination pairings as kind of a bellwether for global growth. The view from outside is that there is some serious concerns about an overcapacity of some of these mega box ships that have been built. Profitability has been held up by above average trade growth. But if that falls away, if we've seen this pull forward of container volumes to the east and west coast of the US, and there's this oversupply of these massively large ships and all of this infrastructure ports have undertaken to deepen their ports and raise bridges, and there could be a lot of investment this year that's been undertaken that may not be matched by demand next year. That's the really big concern that a lot of the major shipping lines have got.
No, I mean, I would agree, and especially if you consider the fact that I think that there's, over the past several months, there's been sort of some pre-importing going on. It may lend to some people feeling like more confident than they otherwise should be. I know anecdotally, there's plenty of reports out there that say that manufacturers in the U.S. have been bringing stuff in ahead of time, especially before this agreement to delay tariffs was entered into. What that means is that as you cross over into 2019, a lot of the things that would normally be imported at the start of 2019 just aren't going to be that way. I mean, Chinese New Year is very much like that. Like Chinese New Year comes in the beginning of February this year, and what that normally means is that like the beginning part of January is a heavy import time because everybody has to get things in from China before that economy essentially shuts down for about a month. And so, going into this year, you might expect that the early weeks of January would be pretty strong for China to U.S. kind of movement. But if you subscribe to this idea that we've been pre-importing a lot of things, what that means is that as you get close to this Chinese New Year deadline, there's just less of a need to do that. And so people might be expecting like a big surge, and it's just not going to materialize.
Well, about 90% of global trade moves by sea. So when we track the Baltic index, the dry index, what we see is that container rates have been increasing to the east and west coast compared to every other OD pairing from, say, the Mediterranean to South America or to Asia. All those rates have been decreasing over the last 6 months, which tells us that rates have only been increasing to the east and west coast because of this pull forward of pre-tariff type inventory, which is not time sensitive. So I think there's a general feeling outside of this country that global growth is slowing down. So I think the outlook for the first part of next year is one to watch really closely. We need to watch some of these early indicators.
And then just really quickly on the capacity side, I've maintained sort of all year that the big bottleneck within trucking, the reason why trucking feels as constrained as it is, on top of the regulatory impact, it's just been the lack of availability of drivers. And so when thinking about capacity, normally I just like to see what the trends are in hiring within the industry, whether or not the trucking industry is adding jobs or not. Trucking hires have been pretty positive. I mean, you can see in the graph here, there was a significant change in the trend around the end of 2017 where hiring picked up in the industry, and it's continued throughout most of 2018. Slowed down a little bit over the past couple of months, but still in a positive direction.
Right.
And I would expect that to continue as long as freight demand remains pretty tight. Like, as long as the economy is doing well, I expect that trucking is going to feel a little bit capacity constrained, and there'll be this incentive to hire more drivers, and that means higher wages and higher job gains in 2019.
Yeah, and of course the trade cycle has been shortened, and you've got a lot more newer trucks out there, more fuel efficient.
Sure.
There's a number of things that are happening that have been driven by higher wages.
And then just quickly on what all that means for freight rates. I mean, if you consider that demand has been pretty strong throughout the course of this year and capacity has been increasing, it's led to a very strong year for freight rates. So this is producer price index data for long distance trucking. The producer price index is essentially a measure of the prices that businesses receive for things. And so this is a measure of sort of the rates that the long distance truckers are receiving for their services. The monthly gains have been still pretty positive. I would say that they've slowed down a little bit since the middle part of the year, and the year-over-year growth rates have certainly calmed down quite a bit. But they're still making what I would consider solid gains in rate increases from month to month.
Right.
And so I think momentum is still pretty good. As you go forward, again, into 2019, we expect slower growth in demand, and we also expect the capacity is going to increase some. So I would expect that these year-over-year growth rates continue to moderate quite a bit. I think settling somewhere in the 5 to 6% kind of range feels a lot more realistic than, say, the double-digit or close to double-digit pace we've seen earlier in the year.
All right, so that brings us to just after the halftime mark in our webinar. What I'd like to do is now sort of translate how that's played out in the freight market. With our first slide, we'll have a quick look at national freight volumes. And what's been interesting this year is that demand has continued to grow throughout 2018 and created pricing power for carriers. As a result of constrained capacity earlier on the year, a lot of carriers have been able to obtain pricing power. They've invested in new trucks, they've shortened their trade cycles, they've increased driver pay. There are a number of carriers now having annual salaried remuneration packages. There's been a lot of progress made in this year in a couple of areas. Early in the year, volumes were pretty robust. And if you look at the chart there, you can see the red lines when it sort of falls below our benchmark index. You can see Memorial Day, 4th of July, Labor Day, and then starting in October, a lot of you will recall that freight volumes went soft really, really quickly, particularly in flatbed. The spot rates in the flatbed market fell away pretty quickly. Volumes plummeted. Reefer and dry van stayed pretty consistent, although dry van did decrease at a higher rate. But flatbed was the noticeable market where volumes kind of disappeared, and it was really interesting to us because flatbed is generally considered to be a leading indicator of overall economic activity, especially in the building industry. So what we've seen since Thanksgiving is that national volumes, continue to soften, especially after the retail peak and the pull forward of Chinese imports. A lot of that freight should already be in here. It's got to be in before January 1, or it had to be. And what we're looking at now is that even though volumes are, short-term volumes are soft, it's interesting to note that volumes are still higher year over year when we look at a 12-month time frame. But what we don't know is where this is heading, and there'll be some interesting discussions in our next monthly webinar when we start to look at what this means for Q1. In particular, if a lot of this volume that you've just talked about, Ibrahiim, is already in warehouses, this pre-Chinese New Year volume that we normally see early in January starts to bump up some volumes. What I wanted to do is just give you a quick look at national freight volumes and market share on the two coasts, because a lot of our freight, in particular freight that comes into the west coast of Long Beach, the Port of Los Angeles, tends to filter out across the country. So it's an interesting bellwether for economic activity across the country as it relates to trucking. What we saw back in November, if you can see that white line on the chart there, that's the outbound tender market share. These were the number of loads being tendered into the market in the Ontario area, which is eastern Los Angeles, Imperial Valley. And what we saw for the first time in November was that the Ontario market dethroned Atlanta as the nation's biggest market volume producer. So if you can see there, the white line kind of jumped a little bit higher than the national volume, and Atlanta, if you look at those two lines there, Joliet is the green one, which is another fairly decent-sized market just south of Chicago. You can see that they remain, there's a little bit of volatility, but for the most part, they kind of hover around 3 to 4%. But the big change we saw was in the West Coast market. And of course, if you've been reading our commentary, we've been saying to carriers and shippers and brokers for quite a while that there's been a lot of volume on the West Coast, but that has fallen away pretty quickly since the shipping volume started to drop off. So that was a kind of interesting one for us. The Ontario market volumes are back down where they should be, but to Ibrahiim's point about the pull forward of pre-tariff freight, you can see that spike in late November really jumped up the market share out of Ontario, and as a result, spot market rates were pretty attractive for a lot of carriers working in and out of that market. On to the next one, on the East Coast, it was a little bit different. What we see here is the blue line represents the outbound tender market share. So these are the share of loads being tendered into the market out of the port of Savannah, which of course reflects a lot of that Chinese to North America East Coast freight. And the Savannah market felt a real surge in volume. And in particular, there was about a 6-week lag between when the orange line, which is the prices of freight on containerized freight from China to the East Coast, you can see it increased about 77% between immediately after July up to about the middle of September. And then there's this 6-week lag between when prices increase and when the freight actually arrives in port in Savannah. And what was interesting in our analysis was that even though prices had jumped 77%, the actual volume of containers had jumped 98% in the period September through November. We're now seeing that volume start to taper off as a lot of that freight is already in inventory, and a lot of that time-sensitive freight before Christmas and the early retail season push has already started to dissipate. So if you are a Sonar subscriber, you can track a lot of this activity and see these changes well ahead of time. But we've been watching all year the movement in container prices, and they generally start to predict volumes on the east and west coast by about 6 weeks. And of course, the East Coast market it was typically about $800 cheaper to move a 20-foot box from Asia to North America on the East Coast for quite a period of time. And for a lot of warehouse shippers, that was able to eliminate a lot of the road transport costs of bringing the freight into the East Coast, so they could move a lot of freight around east of the Mississippi pretty quickly. So that's kind of the highlight on the West Coast. Volumes have fallen right away now. On the tender reject side, we see a very different story. The tender reject is kind of an indicator of carrier behaviour and willingness of carriers to reject dedicated loads in the market, also their willingness to haul freight in the spot market. And if you see the chart there where the green area is, that's kind of the early part of the year. We're down about 53% compared to this time last year. Rejection rates have fallen back after the pre-Thanksgiving surge, which you can see there's a little bit of a surge there in the red area, but they've fallen right back down. So there's some seasonality at play here. We think the market was front-loaded. There was a lot of pre-tariff volume artificially holding up the market. But there's a general consensus here at FreightWaves that the freight market may have already seen its peak, especially given that we're 53% down on where we were this time last year. So there's some, as carriers head into the bid season, there's some serious concerns about how this plays out. We're kind of hoping that a lot of the volume that's in inventory as a result of the pre-tariff pull forward kind of trickles out and doesn't hit the market in massive spikes, causing all sorts of problems for supply chains. On the East Coast market, one of the big markets that we typically watch is Atlanta. It typically represents about 5% of market volume. For the most part of the year, it's the country's largest market. And the chart here that I wanted to show you was the difference between tender rejections and the volume. So compared to this time last year, volumes are up about 25%. It's our largest market. Volume is higher year over year, but rejection rates are much lower. And there was a couple of things going on when we look back at this time last year. This time last year, it was a much more volatile period of time. We had the ELD mandate coming in on 12/18. There were some hurricanes that were playing havoc with the markets. There were significant retail volumes. And then, of course, as we moved into this year, if you follow the white line leading up to about July, that's when we started to see a lot of higher contract rates take effect. And what that meant was that carriers could benefit from higher contract rates, so they tended to haul more dedicated freight and play less in the spot market, which partly explains why rejection rates have dropped about 70% since July. So there's a lot more willingness for carriers to haul freight in the dedicated space, even though volumes are up year on year. There's certainly a downward trend since the start of July this year. So, but we don't see a lot of flow-on effect from the Port of Savannah. They tend to be operating in somewhat of a disconnected way at the moment, but generally speaking, tender rejections are significantly down. And what we wanted to do was also show you a little bit of a view of Convoy's view of the world. It's their market supply index, which is an indicator of how easily trucks can book freight in the market. The Convoy supply index data shows that volume has been fairly stable across the country, even though in some areas it's trending slightly downward. Convoy have been telling us that the biggest split is on the West Coast, which we've kind of seen through our tender rejection and volume indexes. In the Pacific Northwest, the tail end of Christmas tree season is keeping capacity pretty tight, even as some pretty big storms hit the West Coast as we're speaking. In the SoCal area, California supply is plentiful as demand continues to fall due to low inbound port volumes. What's interesting is, even though that said, this year has been an amazing year for the two ports. Port of Long Beach will record another record year. They'll surpass last year's record 7.5 million TEUs, 20-foot equivalent container units. We think probably in the next couple of weeks they'll pass that. So again, volumes have been absolutely amazing on the West Coast, but volumes are tending to slow down right now as we speak. Another thing I wanted to share with you just before we start to go to question and answer is this flatbed activity that we saw mid-year. This is the DAT Freight Barometer, which is a really good indicator of activity by trailer type. So here we can see flatbed, reefer vans and dry vans, and for the most part, reefer vans and dry vans kind of bumped around at the same level, nothing spectacular. But from the start of this year, we saw the flatbed DAT barometer jump 70% up to about mid-year, and since then it's fallen off about 110%. And this is kind of really abnormal spike. And if you think about flatbed as being an interesting indicator of the overall economy, what's interesting here, we think, is that this spike was caused a lot by a really big construction push. It was a booming economy in the first part of this year, certainly perceptually. The tax cuts certainly stimulated a lot of investment, and it seemed to be that this was more of not necessarily a normal seasonal spike, but just a kind of a one-off spike where flatbed volume really spiked. And some of the DAT rates we've been seeing tell us that flatbed spot rates have been pretty high for the most part of the year, certainly up until about August, September, when they started to fall away. So flatbed carriers this year have had a really good year. It's been one of the best years in a long time. And a lot of it's been caused by, we think, a lot of the economic stimulus from tax cuts and general economic investment. The last slide I wanted to talk about that's another indicator of overall economic activity and trade cycles. Prices for used trucks on our ACT research index tell us that they've been increasing. So for 3-, 4-, and 5-year-old trucks, they've certainly been increasing right up to the end of October. We've been following the auctions that have been occurring in the last week. Even though auctions are starting to slow down this time of the year, the last 2 weeks of auctions show that volume is back up, which is not surprising as more new trucks hit the market. Volume is sort of, the levels were lower in October, and there's a little bit of downward price pressure we heard at the auctions this year. So as new truck orders drop significantly in November, we've heard that they're down about 47% since August. New truck orders are down around 27,500. The real concern, and this is where I opened the discussion, Ibrahiim, with you earlier, I could never see the demand for record levels of Class 8 trucks. And I think we're heading into an area now where maybe there's a potential oversupply situation emerging into Q1 as more trade-ins hit the used market. Would you concur?
Yeah, I mean, and I think this is part of the consequences of it just being such a long production cycle. Like in order to get the trucks out there, you order them well in advance.
Right.
It takes about a year or so.
Right.
Between the time that you order something to the time that it actually is out there on the road.
Yeah.
And in that span, a lot of things can change, right?
Right.
And so you you sort of see like a strong economic environment. You say, okay, it's time for me to gear up,
right.
And get ready for all this volume that's out there. And so you place the truck orders, and then once you get to 2019, you're stepping out and realizing that growth isn't quite as strong as it was the previous year.
One of the things I'm thinking that could happen is there could be some significant downward pressure on used truck prices. And I always use, I bought a 2003 379 Peterbilt back in 2009. On the far left of that graph, you can see prices were fairly low. In fact, that was when we lost about 25% of our capacity in the market during that period of time. I paid $35,000 for a truck with 700,000 miles. That same truck now is about $75,000, and I expect my fear is for the used truck market that those sorts of prices from 2009 levels could re-emerge if there is this oversupply of trucks that hits the market. Now, that's kind of our sort of worst case scenario. We'll be watching very closely new truck orders and price levels over time, and we'll report to you as soon as we start to get some of those indicators. If we could just quickly flip to weather, the weather, Winter Storm Diego was kind of significant. And you can see on our weather map there overlaid on the outbound tender rejects, you can see the bottom right corner in the southeast. The dark grey area is snow and ice. And what was interesting in the Charlotte market in particular, there were record levels of snowfall on average for the first snowfall of this region is not generally until about January. So to get this snow on December 9 was really, really unseasonal and unheard of. There were some record levels of snow for a December, a single day in December. Lots of disruption in the freight markets. There are about 300,000 people that lost electricity. We kind of predicted on FreightWaves Now the week before that the first 3 days of that week, on the 10th, 11th and 12th, there'd be significant disruptions to the freight market. It turns out that even though there were some fatalities, including a truck driver, the impact on freight markets in Roanoke and the Charlotte market were fairly localized. But what we did see is that outbound rejection rates were falling in Charlotte in front of the storm as carriers attempted to move out of the way. But immediately after the roads became clearer and people could get back in and shippers could start shipping freight, tender rejection rates in the Charlotte market jumped 40% back up that week as state freight started to flow. So nothing else sort of remarkable other than the fact that this storm was sort of unprecedented in its timing. We saw the same in some of the New England markets where we've seen snow ahead of Thanksgiving, which we don't normally see. So there's certainly some unseasonal things going on disrupting the freight market. Last two slides, I just want to touch briefly on oil prices and diesel prices. If you've been reading FreightWaves Daily Watch, you'll be following with much interest the turmoil that's in the global oil market, the oversupply situation that we're heading into. Excuse me. General highlights, if you look at the WTI crude spot index, oil prices have continued to plummet. They kind of stabilized in December, bumping around the $50 to $55 mark. Just before we came on air today, the WTI was trading at $47 a barrel, which is kind of, danger zone. It's off 33% from its $76 a barrel high on October the 3rd. Shale production companies tell us that around $50 or slightly less is the cost of producing shale oil. So we're kind of in that territory where if there's this oversupply tends to become more dominant, this could become a pretty serious issue for the number of rigs being installed. So we'll be watching rig counts pretty carefully in the next coming weeks. You would have seen that last month there was the OPEC meeting. In fact, a couple of weeks ago, they've committed to reducing supply starting in January. So has Canada, again, which is unprecedented. There's been a lot of change in the pipeline infrastructure, so that should ease some of the bottlenecks. But just generally speaking, there is some concern about global economic growth. But at the same time, US production is increasing. As pipeline infrastructure improves, bottlenecks reduce. We think this supply situation where we're now a net exporter of petroleum products, we think there'll be downward price pressure on oil. But again, if you follow the FreightWaves Daily Watch, you'll be able to read from John Kingston's Daily Insights on exactly where that's heading. Now, generally speaking, on the diesel side, diesel prices are pretty sticky in relation to crude prices. But there's something happening that we all need to watch, and that is that the IMO 2020 regulation that's coming in for the maritime industry, where they need to switch over to ultra-low sulfur diesel instead of the high sulfur content bunker fuel that they traditionally use. there is an expectation that diesel prices could break from crude oil prices. They generally track each other, but we suspect this may put some sort of a demand or a strain on diesel supplies globally. What we don't know is how much low sulfur content diesel will be pulled into the maritime industry to displace these heavier, dirtier bunker fuel type ships. We wrote today about scrubbers and the impact of putting scrubbers on ships, the weight they add, some of the inefficiencies. Some ports, like the Port of Singapore, have already mandated that ships have to use ultra-low sulfur diesel. So that the real unknown here heading into 2019 for diesel prices is how much demand is going to be put on diesel supplies. And we need to watch this closely, especially for motor carriers, brokers and shippers and private fleet operators within the shipper community, is what sort of upward pressure that's going to place on diesel prices. But again, in Sonar, you can track retail prices and rack prices on a daily basis to stay ahead of that curve.
Awesome. Great. Well, thank you so much to Dean and Ibrahiim for sharing your insights with us. We have time for a few questions, so if you've not already submitted those, please do so through the Q&A button in your control panel. Dean, you've talked a bit about our daily watch, and obviously seeing quite a few Sonar charts here, and we've had some questions come in from people kind of about the data itself and how frequently it's updated. Can you just give kind of a quick glimpse into that?
Yeah, some of the data points that Ibrahiim pointed to are more, we say monthly. Most of them are monthly type data points that are coming from the government. A lot of that's got to be cleaned up and populated, so there's a little bit of a lag there. The vast majority of our data points are updated daily, typically early morning. So what you see in Sonar every morning is typically a reflection of what happened in freight markets overnight and the previous day. So the goal of what we produce with Sonar is to, so Ibrahiim gives us the strategic overall direction of where the market's headed, but what the daily watch does within Sonar is it allows you to make tactical decisions. So the job of the market expert team is to take the data within Sonar and help you figure out what tactical decisions you should be doing today. So when we push out the summary of what happened in the freight markets overnight at 10 a.m. Eastern, what that's helping carriers, brokers and shippers do is make decisions about how to price and where to position their assets that afternoon heading into the following day. So it's really designed to be near time. It's not real time, but near time, in that it's kind of a 24-hour snapshot of what happened in the market, and then we use our market expertise to give you some ideas about where you should be thinking about positioning trucks and pricing freight.
Awesome, thank you. I hope that was helpful for those of you listening in who had questions about that. Next question, why do you think that we've seen such a large spread between diesel wholesale and retail prices over the past several weeks?
So part of the reason is the idea of they're just having difficulty getting the stuff from U.S. shores into the global market. So the U.S. is producing an awful lot of oil right now, and if there weren't any kind of frictions between us producing it and getting it into the global markets, then the prices should be relatively close to one another. There's some quality differences between what Brent is and what like the WTI is, but I think the big problem is just like there's some bottlenecks in terms of getting that stuff into the global market. And so what you end up with having is just like just much more oil in the domestic U.S. than can get out there.
There's also a lot of volatility in the market in terms of news. Like the market's trying to absorb so much news on so many different fronts.
Sure,
it's been really hard for them to figure out where things are going.
Great. All right, and then do you have any predictions or insights around the spot market in 2019?
I mean, if I had to make a general prediction, I would say it's less volatile than what it was in 2018. Like to me, from the time that you have like the soft implementation of the ELD mandate on, it's just like there's been a lot of question marks about sort of what the state of freight is going to be, and then on top of that, you kind of had an economy that caught the freight market, the freight industry a little off guard. Like growth accelerated pretty quickly in the U.S. economy, and so as a result, I don't think everybody was prepared. And when that happens, you end up with having difficulty finding drivers, opting to go to the spot market instead of honoring contracts and things like that. And so my guess is, I mean, if I had to make a prediction, I would say that it's going to be significantly less volatile.
Yeah.
I don't think there's going to be the same kind of surge in demand growth. And I also think that, like, on a regulatory side, there'll be less surprises or less unknowns to cause that kind of volatility there.
I think there'll be opportunities within certain markets. What we've seen this year is that even though, if you look at reefer, flatbed and dry van, and particularly short, long and medium haul, you've seen spot prices kind of move around in certain markets. Well, you know, and a head haul index is a really good indicator of where there's freight imbalances. I think generally speaking, there'll be less volatility, so I concur with that, but I think there'll be lots of opportunity within specific markets where Sonar can tell you about you know, what sort of positions to take opposite to how the rest of the people in the market might be thinking, because it gets down to fairly granular views of key market area activity. So I think less volatility, but more opportunity if you can understand how the freight imbalances are and where they are and when they're occurring.
Okay, great. And we'll take one more. For those of you who had questions that we don't get to, we'll be sure to follow up with you after. You touched on this a bit, Ibrahiim. The current turmoil in the stock market is telling us something about the economy in 2019. Do you think that this reflects problems ahead because of the trade and tariff wars? And do you have any key takeaways?
Well, generally speaking, like I've kind of interpreted the recent stock market decline as people coming to grips with the idea that a lot of this stuff is real and it's going to start affecting economic growth next year. Like, I think for a long time, you know, and I'm guilty of this also, but there's kind of this feeling that you know, these looming tariffs are out there, but they weren't necessarily going to actually be implemented. That as you go through it, you know, you kind of figure that they'll come to some kind of deal to make it all go away, and then we'll end up in a better environment. But I think lately investors have just kind of realized that it's not necessarily going to go away. And signs have started to emerge that the economy is slowing down some. And so it feels a little bit like just kind of correcting to those kind of expectations. You know, the old rule of thumb is that, like, the stock market will give you about a 6-month advance look into what happens in the economy. Now, that doesn't always hold. There's plenty of instances where that doesn't happen. But if you do subscribe to that kind of idea, I mean, it really just is a realization that I think most people realize once you get to the first and second quarters of next year, growth's just not going to be the same as it was in 2018. And profits, you know, corporate profits aren't going to be the same as what they were in 2018 either.
Great. All right. Well, everyone, that is all of the time that we have for today. So thank you again for taking the time to listen in. Thank you to Dean and Ibrahiim for sharing your insights with us. And thank you again to our partners at Convoy for sponsoring today's webinar. So be on the lookout for next month's webinar invite in your email in the next couple of weeks. We're also looking toward our Transparency 19 event, which will take place in Atlanta, May 6th through 8th. Tickets normally go for $24.95 each, for being offered for $9.95 until January 1st. And at that point, the prices are going to go up. So make sure you get those sooner than later. Also, if you joined us at FreightWaves, you can expect more great content, demos, and networking opportunities, all of which are centered around the digitization of the freight industry. So if you'd like to learn more or join us at Transparency, visit www.transparency19.com. And you can find all of the information you need there. So thanks again for joining us today. We hope you have a great holiday season and hope you'll join us again next month.